Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through the comment section. I'm going to give you my financial opinion and comments back to some of your guys' comments, and we'll go from there. So let's go in. Let's see what's going on with the comment section. I'll blow this up here real quick, get me out of the way, and we'll see what's going on here. So it says, ratio analysis must be a two-legged trade. The SPY can fall dramatically, and so can gold. In that case, your one-sided trades will be pulled out from under you while the ratios perform as expected. Except, here is the thing, you still win. You don't have to win in dollar terms to win in purchasing power gains. Guys, you have to think at a higher level, I would say, than just making money in dollars. So if everything in the world goes down by 50% and your gold goes down 10%, that is actually the preferred scenario because you gain purchasing power gains without paying taxes. That is exactly what the government doesn't want. They don't want you making money or they don't want you making purchasing power gains where they can't tax you. The whole game is set up for them to make money off of taxes. So when everything goes up through inflation, you can be losing purchasing power gains and still be making money. And if you make money, they're going to tax it. But you can make money and lose purchasing power gains. You can lose and you can win and still lose. Now, in the scenario that you're describing here, where you've got two assets, this one blows out to the downside and this one falls a little bit, you're saying you still lose money on this. The game isn't about making money in terms of dollars. The game is about making purchasing power gains. If my goal is to buy a house, all right, I'm just going to make an easy example. If your goal is to buy a house and you load it up let's say you loaded up $500,000 in gold, right? I'm just making up a number. It can be whatever number. And house prices were to drop by 50%. And I'm not saying this is going to happen. I'm just giving it as an example, guys. It drops 50% and your gold holdings drop 10%. You win. You win big. And you don't have to pay taxes. So two things can go down, but you still win. And just because you see a loss in paper dollar terms, you still win big because you can rotate that asset to something else and buy more of that asset. And you just continually rotate between assets the entire time, accumulating more and more. I'll put it this way. You've got gold here and platinum here. If the price goes down and you have a gold, the ratio, if the ratio goes in a favorable direction, let's say platinum goes from 0.5 to 1 on gold. You swap your platinum to gold, you have 20 ounces, 20 goes to 20. Platinum crashes and gold doesn't crash as much, and the ratio goes back to 0.5 to 1. You swap your gold back over to platinum. You get 2 times the amount of platinum. Did you win? Yes, you have 2 times the amount of platinum. The dollar terms is more or less just an accounting mechanism. It doesn't mean anything. The value is the assets that you get. So divorce your thoughts from dollar and assets. The goal isn't to make more dollars because you don't know if you're making more purchasing power gains. The goal is more assets or purchasing power increases. That is your goal. So if everything falls down and you fall less than everyone else, you win. It's all relative, guys. It's all relative. It's like making money. If you go to a job and you're making money, and I were to give you an example, and some people are really stupid, so we need to extinguish this from your thoughts. Would you rather make $50,000 if everyone else made $20,000? Or would you rather make $100,000 when everyone else makes $200,000? You want to do the first one because you're making more than everyone else. And in that system, it's all going to be relative. You could just say that was you could say that was 1990 versus today. So it's all relative. And a lot of people are going to choose the more money. They don't get it. So coming on down, it says, we are experiencing lots, and I think he meant dire. We are experiencing lots of dire warnings in the market currently. The markets have not fully decoupled from the commodities market, so we are seeing that fluctuation still, which leads to anxiety, sell versus hold. Well, here's the thing. We have decoupled, and we do see a outperformance of commodities in relationship to stocks. It doesn't mean that we're going to be inversely correlated. Inversely correlated means that when the stock market goes down, that commodities must and have to go up. What could happen is that some of these major sell-offs in the overall market, we still go down with it. We go down less. But when we go up, we are amplifying the move higher. So we are trending higher in commodities, although the stock market still has a weak link to commodities. So they still fall on down days together. But commodities go far higher on up days and they go far lower on down days. It doesn't mean that they'll be inversely correlated where one goes down, the other goes up, and it's this complete, easily seen disconnection or decoupling from the markets. Decoupling does not mean that. Decoupling means that the how can I say it? The interconnectedness of the market is breaking between the two. It does not mean that they're inversely correlated. Joel Glenblatt stated, one must understand the thesis to be able to hold. Go back and take another look at Andy's thesis. Do you still agree with your decision to buy, hold, anxiety too high, throw the virgin into the volcano and sell some? But ask yourself, where will the market be in 6 months? The noise is because Jay Powell is the second coming of Paul Volcker. Really? Better Google the U.S. debt clock and then ask, how can we afford the UST rates at real rates? Real rates is above the inflation rate. A 1% rise is $300 billion for the government to pay from taxes. Use the fear from noise to buy drawdowns. Personally, I think Andy's thesis is brilliant. Well, this is what you could go through, guys. If a lot of people get worried about losing money or having an account that is down, I'm going to tell you this: it's going to happen either way in commodities. You're going to get 50% drawdowns or 60% drawdowns, no matter what. That's going to happen. That's how volatile these things are. And a lot of people avoid commodities altogether because of those drawdowns. It's a part of the game, and that you must learn from the game. You can't change the game. You can't do that. But if you can't handle the volatility, you should not be in commodities, especially these producing companies. You could go into like gold and silver and those types of things. But the actual commodity stocks, they are incredibly volatile, and that's just the way they are. And here's the thing. You can try to time this recession. A lot of people are going to get it wrong. They're going to miss out on opportunities if you're trying to time things. I see the saying a lot. A 50% drawdown means you have to have 100% gain to make your money back. That is true, but if your risk reward is massively to the upside, it's an asymmetric bet. If it's a 20x to the upside and 50% down, then that 100% doesn't matter as much. As long as you at some point get that big payout in some of your companies. You're not going to win on everything. It's the way that you set up the portfolio, the way you allocate your portfolio, the way that you keep your position sizes to a certain size. So if the market imbalances are so great on the opposite side of this, if you know for a fact that we are going to be going into market balances that are just completely lopsided, which makes this a very large asymmetric bet. And these bets that we're making in commodities, they work right before a recession. So all of this kind of aligns with that recession. But I think even if we were to have a recession, if they were to push these rates way high or whatever, I don't even know if Powell's in the driving seat here. The 2-year yield is way higher than where the Fed funds rate. And do you think the Fed funds rate, the overnight lending, is going to do anything to inflation? I don't know. I don't think so. I think they don't have much control over this. What they're trying to do is control everyone's psychological, paradigm on this. they're talking the game. But I don't, in all honesty, I don't think they can slow this thing down that much. And we'll find out. We'll find out. I think it's naturally slowing down. I think interest rates naturally go higher in these market conditions as people sell bonds. But do you see that slowdown? If we're really going to have a deflation, if we're really going to deflate, and the banks think that we're going to deflate, and that's the only thing that matters because that's where all the money's being rotated around. If you really think they're going to deflate, you should be seeing interest rates go down. Why are they going up? Why are they going up? Before 2008, go look at interest rates. You know what? We can look at it together right here. This is the interest rates here, guys, of the 10-year yield right before the crash in 2008. So that was a deflationary. We had problems in the banks. If we look, and where we're looking at is back in 2000, right here. In 2007, we had rates dropping for 2007, then all the way 2008. This was dropping here, and it was dropping dramatically. So people were running to bonds during 2007 timeframe. Here's that time frame. This is June 2007. Then rates started just dropping like a rock, and then here's the crash here. There's the crash. There's the rates before it and the drop. We saw a drop in the rates because it was a deflationary type event, and the banks knew that they were having problems with those loans. And now we aren't seeing a drop in rates. We're seeing an acceleration of rates to the upside. I don't think those market conditions are the same. I think we're still early in this mix. And usually the order of events that happens here, usually you have an increasing interest rate environment with the inflation. They pause the rate hikes, and then you start to see a rollover in the interest rates, and then you see a crash. But that could take a year from now. Maybe it's 2 years. We're still going up. So I'm holding on to my shares, and I know people are going to ride through the recession. That's assuming that the recession, this big, huge crash, is coming right now. It may not be coming at this second. It may be out in the future still. We'll have to see what the metrics tell us. And this seems to be moving at warp speed, too. It seems way faster than other setups. So maybe it is closer than what we think. But we should see, at least in my opinion, I think we should see this 10-year yield start to drop and really move lower. We just haven't seen that drop yet. We continue to work our way to the upside. So here's oil and gas, definitely underinvesting there. Agreed. Once big money starts to buying uranium, will rise in a big way. Check out the uranium to platinum ratio. That is a bearish engulfing for platinum right now. Even the wick on the bottom could indicate a large move for platinum. Yeah, so, and again, guys, when I invest, I just pick up a wide array of whatever's cheap. And if one or two of them take off big, perfect. I'm catching that big move. I'm minimizing my downside risk, maximizing my upside potential. And usually, those that are down the most, they don't have much further to fall, but, you know, they can fall quite a bit still, even though they're cheap. Just because something's cheap doesn't mean it can't get cheaper. So you're not insulated from a crash, per se, if we get a crash, like a deflationary type move. But we should be able to see it if it is deflationary through the 10-year yield and these yields dropping. There's one guy in here who thinks uranium is all bearish, so I'd like to go over that too. Says, let's be real, recession's not ending with June bottom. Unless Fed completely reverses its policy, we are going down. Here's the thing, though. Everybody thinks that. Everybody thinks that, at least on the Twitter world, on YouTube. Everybody's so bearish on everything. Here's crystal clean. This is one. Out of commodities, into bonds. That's the play. Oil is a ceasefire away from dropping to the 70s. Uranium stocks are deflating bubble in a distribution phase. That's what he thinks. Here is. So he's saying go into bonds, and maybe he's right. We'll have to see what the interest rates do. But at this time, looking at it, interest rates have been going up, and bond prices have been tanking. We have to see a bottom in bond prices for me to be wanting to jump into bond prices. I don't think they're ready yet. So I think it's kind of premature. I don't see an exact bottom here. We continue to go lower, and the market conditions at this time, with inflation rates way higher than bonds and having a real negative rate where it is, I still think there's more downside in bonds. So that's kind of my take on it. And then looking at a distribution system, so you could look at like a Wyckoff distribution pattern. We'll go to images here and we can show you what that means. So it's basically sitting here moving sideways for a Wyckoff distribution on like a large. I'll copy this. We'll go back to trading view. And we can do some comparisons to see if it looks like a Wyckoff distribution period. Now, here's the thing. You can have a small distribution period over a short-term time frame. We go back a little bit, and then we take off on a larger big picture view. That's kind of where my thought is. I don't think we're bottoming in uranium when the ratio is dirt cheap and we're under the cost to produce in an energy crisis. But we could, in the short term, pull back before another big move higher. So we could be looking at it from different time frames. This is the distribution schematic, Wyckoff events and phases. As we come up, what he's saying is that this here is a Wyckoff distribution phase. Very much like this, comes on up, comes on over, and maybe we have a pullback. But here's the thing. He could be right on the short term. Very well could be. And I'll pull up a different one with a lot more data. We'll do Denison Mines, because that's got at least a good amount of data. I think it's DML on the DML. If you take a bigger picture view, this was the big move higher here before. Maybe we pull back a little bit and then we launch. I'm not saying that I know that I have all of the answers and the crystal ball in the short term, but I can tell you this. The likelihood that this thing is going to fall back down and never go back up, I think, is a low likelihood if you have a long enough time frame. And when your uranium price is under the cost curve to produce for new producers and you're running market deficits, what you're doing is you're prioritizing the technical analysis and putting a paradigm view on this versus the fundamentals of the actual commodity. The fundamentals override the technicals to some degree, and they are one of the same thing. But you should be looking at these technicals from a very jaded viewpoint, from a positive fundamental basis. Uranium, for the most part, running the deficits that we are, has to go higher to bring on new production. The question is when? And we could have a short-term weakness. I mean, looking at DML in the short term here, this looks positive to me. We had a kind of a healthy pullback here. We've got big green army coming in and a small candlestick, down candlestick this month. So it still looks good to me for a move higher. But a lot of people get the technical analysis wrong. They sell out and they miss the big, huge opportunity move to the upside. Not me. Not me. I did that last time. It's not going to happen this time, guys. I'm remaining long in my uranium. I'm remaining long in a lot of my commodities. Why? Because the fundamentals of commodities and the market balances look ridiculous in the mid-2020s. If I have to ride through a recession in the short term, I'm just going to use it as a buying opportunity to buy more. Could I be wrong about a recession happening within a year? Yeah, I could. But the question is, does it matter? And how long will it last? And will a recession work? Will it kill demand forever? No, it's not going to forever. So why would I even worry about the recession? If you worry about the recession and let's say it pulls back 20, 30, 40, 50%, it could very easily. Commodity stocks are incredibly volatile, and we're going to normally see 50, 60, 70% pullbacks in some of these companies. That's a normal pullback. So the overall market, I think, will go lower, the S&P 500, all these different companies, but I think it's because of commodities. I think it's because of energy. That is our problem. And we can see that oil and natural gas has been pretty resilient, even in the face of all this worries and recession and all this other stuff. I think it's the cause. Now, it doesn't mean that it can't go lower. I mean, we're releasing strategic petroleum reserve releases. We are doing everything we can to push it lower. And it's still being quite resilient. But yeah, this fall, when demand goes down a little bit naturally, we've got demand that cycles up and down, summertime, wintertime, and stuff like that. In the fall, it's usually low point, and spring's the low point. We could see better buying opportunities. I'm going to buy the pullbacks and the drawdowns. So that's my take on it, guys. That's what I think. That's what my viewpoint is. People will say, hey, look, you're going to get crushed. If you held through 2007, 2008, here, I'll give you an example. Let's say you held through it in Chipotle, because I was in Chipotle massively. Let's say you bought down here at $58 and you're like, oh no, a recession. You could have a drawdown. So in December of 07, remember we saw those 10-year yields fall back over here. Let me zoom in here. So here it is. You're looking at it, right? You buy down here, you hold on. Oh, you should be selling. We see a drawdown. Let's just say you don't care about recessions. I don't care about recessions. I'm just going to hold on. So it goes all the way back. You buy some more, like over here at like $60, $65 as it goes back up. Chipotle has good fundamentals. You go eat there. You continue to see the growth of Chipotle, and you like the stock. Then all of a sudden, look, oh, well, the drawdown doesn't matter. You need to make 100% of your money if you had bought at $150. Well, now you're up 100%. And you bought more at $60, and you bought at $50-something, and you just ride it. Oh, wait, look, now you're basically killing it, and that's 5 years longer. Then you get the E. coli scare, and this big drawdown all the way back down to 280, 290. It breaks the downtrend line of this, basically this downtrend line there. Then you buy more on this upward move at 383. You buy more. Your cost averaging up, not down. And look, more strength. And now you're at like almost $2,000 at the peak, and you still are going higher. You would have won if you took a long enough time frame. If you took a long enough time perspective, you would have won holding through all these recessions. So then the question is, should you hold through this recession? Well, that's up to you. I can't tell you what you should be doing, but I bought at a really good time. I did in 2020, and I bought in 2021, and I bought in 2022, and I'm buying pullbacks. Why? Because the fundamentals justify me doing it. The ratios are cheap. Uranium, that ratio is cheap to all other assets, and it's improving in a positive way. I can't control what the market necessarily does, but I can tell you this. The market under these market conditions usually are favorable for commodities and precious metals. If you were to look at the cycle, the first thing that goes is usually oil in a pretty steep fashion that transfers all that inflation into the consumer price index through oil prices. Then you see other commodities start to take off. Uranium is usually after oil and natural gas. Uranium goes kind of next. At least that's what it was back at the other bull market in the mid-2000s. Then precious metals are the laggards. They lead, they go sideways, and then they come and lag behind it. So we're seeing that, and we can use these assets the way that they perform to see where we are in the cycle. And I don't know if we're ready for this deflationary type crash. I think it's more like the 2001 NASDAQ bubble. You've heard me say that before if you go back and look at my old videos. I even laid out in 2020, 2021, what this is going to look like. I laid it out. I said, we are going to see inflation come up. I told everyone we're going to see increasing interest rates as interest rates chase that inflation. And then I said the stock market's going to roll over, which it is. And then I'm going to say commodities are going to go up, and we're going to get in a difficult period where commodities and stocks are going to be dragging back and up, and we're going to have to decouple, which we are and we have, but we could still get dragged lower if we see dramatic moves to the downside because of the leverage in the system. I said this is the most difficult time to be holding because it's going to be moving all over the place. It's going to be very volatile. But that's the way the cycle is. That's what it was last cycle. So if you guys need help holding through this stuff, subscribe to the channel, subscribe to the website, finding-value.com, Platinum membership if you need further assistance, further financial education, things that can help you hold through. And I also go over a lot of different companies that I like and what my opinions are on those companies and what's in my portfolio. And you can see my portfolio. The gains, if you want to know what the gains are, my 2-year gains are 550%. My 1-year gain is 52%. Or year-to-date gain, I should say. Year-to-date. It was at 60, but we had a little bit of a pullback. I'm very heavily weighted in oil and natural gas. That's where my gains are coming from. And whatever oil and natural gas does from a volatility perspective, that's usually what my portfolio is doing. My largest position is very large. My largest, I should say, 3 or 4 positions got pretty big. And they're basically driving the portfolio performance at this point for a few of my portfolios. And that's my more energy-heavy one. I do have a portfolio that's also in more diversified, and it's, I would say, slightly up on the year. Not nearly as good as performance as my energy-heavy oil individual stock portfolio. And then I've got the physical metals as well, which is mainly kind of tracking sideways to slightly better. I don't really track that performance. Hard to track it because it's all outside the system, but that's the performance there. If you guys want to see or try to match that, portfolio allocation size, position sizing in particular companies is more important. I talk a lot about that on our Platinum question and answer sessions on how I allocate money and how I get these returns and what I think is more risky and what's less risky. So that's what I've got, guys. Hopefully you enjoyed the content. Give me a thumbs up, and we'll catch you next time. This is Finding Value.